Welcome to It's the Economy. HSBC India has put out a very interesting report on consumption trends in India, which will be of a lot of interest to actually stock market investors also. The Chief India and Asia Economist, Pranjul Bhandari, says that until last year, India's agri and informal sector saw low consumption due to climate and other shocks, while the formal sector grew very strongly. Starting this year, the agri and formal sector may do better due to low inflation, benign monsoons back-to-back, while the formal sector consumption may go down because of tariffs and other problems hitting GDP growth. Now, an equities person will probably interpret this that consumer staples may do well here on, and we're already seeing it in Marico's numbers, and discretionary consumption may slow down. Well, that's my inference. That's not Pranjul Bhandari's. But let me get Pranjul Bhandari, the economist from HSBC herself, and the author of this very interesting analysis. Pranjul, good morning. Thank you very much indeed for joining us. First, present your thesis to us.
Okay, thank you very much, Latha. So, look, I think if there's one thing you want to track in the economy this year, it should be consumption. Because at a time when external demand is impaired because of all of these tariff-related uncertainties, those economies that can unleash domestic consumption firepower are the ones who will see much stronger growth. So where does India stack up on this front? I like to break up India's consumer into three parts. One is the agricultural informal worker, the other is the non-agricultural informal worker, and third is the formal worker. Interestingly, all these three groups make up 1/3 of consumption each. They're equally sized groups. In the last couple of years, both the agri and non-agri informal sector worker was doing very poorly as consumption was weak. Overall consumption growth was about 4.5% below overall GDP growth. Whereas the formal sector, the third group, was doing much better. They had the benefit of high wages, equity market returns, which were very strong, access to personal loans, which were rising very rapidly, and they were consuming a lot. Unfortunately, they only made up 1/3 of the consumption basket. And if you look at overall consumption was not very strong. But everything is having a reset this year. The informal sector, agri and non-agri, are doing much better. There has been a bumper crop, wheat, rice. For the urban informal workers working in small firms, commodity prices are falling, which will be good for their profitability. Inflation is falling, which will be good for their real purchasing power. So 2/3 of consumption is doing well now, whereas the remaining 1/3, which is formal sector, is going to fall. But overall, after many years, we are going to see consumption growth actually being fairly strong, in fact, stronger than overall GDP growth, simply because the informal sector is going to do better than before.
Okay. Well, that's actually very good from an equity angle as well. Was my inductive leap correct, Pranjul? Since I'm a stock market reporter, I tend to look at it as staples may get more demand now because the bottom of the pyramid will be better off.
Yes, absolutely. I think you got that right. And I can already see that not just in the equity market results, but also in some of the macro data that I track, that rural wages have been ticking up in the last couple of months. Very interestingly, in terms of the share of unpaid workers in India are very large. They are falling, and the share of paid workers is rising, which is good for the informal sector incomes. And finally, we are also seeing very interesting thing in GST collections, that domestic GST collections are rising, which means that the small firms are also doing well. So we're already seeing this in the data.
Yeah, actually, Nielsen put out an interesting data as of December 31 when they analyzed, and they also said that small firms are seeing more demand. One assumes that they are in smaller places. But Pranjul, you're also, you put in a caveat saying that overall growth is going to fall. What are your growth numbers, and are they even lower than 6?
So look, overall growth numbers are going to fall. And, let me put all of this in context. consumption growth is going to be better than before, but investment growth is likely to be worse than before. The formal sector, which was doing well, people like you and me, Latha, with proper wages, access to social welfare, people like us were doing very well in the last couple of years. But if our consumption softens in the next couple of quarters, then remember, we are also the investing class. We have the surplus, we buy houses, we take mortgage. That demand is likely to come down, and that's a very important part of investment growth. So my sense is this is going to be a year in which investment growth will be lower than consumption growth. Completely the opposite of what we saw in the last couple of years, where investment growth was higher than consumption growth. So one thing that's going to be weak is going to be investment growth. The second thing that's going to be weak, I think, is personal credit growth. The demand for personal credit growth is going to fall. If the formal sector is not going to be buying houses, then the demand for housing loans will fall. If the informal sector is now finding enough incomes, they may not take consumer loans to make their consumer needs. From both consumption and investment loan perspectives, credit growth may actually fall off compared to the last couple of years. The only silver lining here is that it's good for the consumer, for household to go through a period of deleveraging, because when the new growth cycle starts, they will have much healthier balance sheets. But I want to put all of this in context. Informal consumption will be better than before, but investment growth could be softer and credit growth could be softer.
Oh, that's a very interesting and convincing thesis, Pranjul. I just want to correct one of your premises. You began by saying that people like you and me, please, media and journalists have not seen increments in a very long time. It's a highly disrupted sector. But I hope you and your ilk are doing very well. To come back to the growth pace itself, the IMF and even the Reserve Bank have pulled down growth estimates, the Reserve Bank from 6.7 to 6.5. But on the street, I got much lower estimates. The numbers I got were between 6.1 and 6.3. Have you recently downgraded GDP growth forecasts?
Look, our GDP growth forecast for this year, with enormous amounts of error bands, because we don't know where the tariff storm will rest, is 5.9% growth, which is about 50 basis points lower than India's potential GDP growth. Look, this assumes that our reciprocal tariffs will be at about 26%. Right now, of course, for 3 months, it's been put at 10%, but we don't know where it will be after 3 months. In case our reciprocal tariffs are not increased very much, then I will be very happy to upgrade my growth numbers. But, even if I upgrade my growth numbers, I'll probably upgrade it by about 10 or 20 basis points. The reality is that global growth, global trade has been disrupted in a major way. And I think in a quarter's time, we'll start seeing that in our GDP growth numbers.
Okay. Well, just to play the devil's advocate, the factors that could be propelling growth, we have this income tax rebate, income tax cut, which becomes effective from this month. No, actually, now from last month, from April. So a little more consumption, money is available in the hands of people to spend. And inflation is falling for all of us as well. Interest rates are falling. The 10-year yield, when was it last at 6.3? I think COVID years, 2021. So cost of loans is lower. The expectation is that this will also keep the formal sector and consumption propelled. You're not buying that part of, higher take-home pay and lower cost of capital, lower cost of interest can push up consumption?
Look, 5.9 to 6.1% real GDP growth in a year where global growth is likely to fall, countries like the US are going to come to a near recession-like situation, is actually a very strong growth outcome, Latha. And I must say, within this, I'm buying what you're saying, that consumption will do very well. But remember, on the other hand, investment, which gave us a lot of boost in the last couple of years, will not do very well. Household demand for real estate, FDI inflows around the world, which propels corporate investment, I think all of that is going to be very weak. So we have to keep both of them together. I also agree with you that the income tax cuts are going to help the formal sector consumption, but I think only on the margin, because this is the sector which tends to save more than they spend. Their marginal propensity to consume is a little lower. So I don't think the income tax cuts can solve all the problem of the formal sector. So while I agree there will be relative winners and losers, and I think the informal sector in a crude way could be a relative winner because, weather is supporting them, low inflation, low oil prices are supporting them. On the other hand, we must remember that this is a year in which growth everywhere is impaired. So overall growth will be a bit softer than before.
Okay. Yep, 5.9 would be a bit of a shocker, but you're not alone in that sub-6 number. There are a couple of people who are extremely worried about the global headwinds. And as you say, even in the formal sector, I think the upcoming interview is going to be with Indian hotels, and they are shown 30% profit growth, 35% margin. So yes, there are exceptions there. But Pranjul, since I have you with me, I wanted to ask you this inflation question. There was a large expectation of disinflation because China is not able to push its goods, or Vietnam is not able to push its goods into America, and therefore there will be general disinflation in Asia. But lately in India, there have been 2 or 3 things which is worrying inflation forecasters. One, anti-dumping duties on steel, and therefore local steel products could get expensive or have gotten expensive already. The other one is just now, after a 2-year hiatus, we saw milk prices being raised by Amul and some of the big milk producers. So do you think RBI's 4% inflation forecast is under threat?
No, I don't think so. I think it's very clear to me that we are in a period of low inflation for the foreseeable future. I think the biggest thing that's worked for us is food inflation coming down. And it's not just a story of vegetables and fruits, which is generally just a 3-month story. It's a story of lower cereal prices, which have been a big pain point for the last couple of years. We've finally been able to get enough rice and wheat production over the last 4 to 5 months. Government granaries are full up. And this, once this is full up, it becomes basically a cushion for the next year or 2 because cereals can be stored. So because cereal is falling, cereal inflation is falling, I think it makes low inflation a little more sticky. So I would say, we are doing well from that front. Also remember, 3 months ago, we were so worried about the currency depreciating and the FX pass-through of that. Now the currency is much stronger. That whole FX pass-through story has subsided. And finally, we have oil prices which have come off in a major way. So I think we should keep all of this in context. I agree there are some sectors like steel where the story is different, but the overall macro story, I think, is firmly for lower inflation. In fact, I would say that inflation could be much below what the RBI is projecting. RBI is projecting about 4% for this year. My sense is it will be closer to about 3.7%. Basically, creating a lot more space for the RBI to continue with its, soft monetary policy.
I'm being warned I'm out of time, but what's your forecast in terms of RBI cuts? Is the end repo rate 5.5, or does it go even lower?
5.25 for me, so 3 more rate cuts to go. This would basically mean it's going below neutral policy rates,
Fair enough.
which is what you need if growth is weak. And
fair enough. If you have an inflation which is going to be under 4%, under their mandate, they will have to go under their understood real rate. That expectation is very much there. Thank you very much, Pranjul. Out of time, but that was a very interesting conversation. Pleasure speaking with you. Have to wrap up on Bazaar. Chartbusters coming up after the break.